Hey, good week, business partners. I'm Erik Waterman, Affinity Home Lending, MariettaHomeLoans.com. This is the week of Thanksgiving. This is where we give thanks for all the great and wonderful things in our lives. Me personally, I like to give thanks to my family and my very close friends, my business partners, people that I've met over the last 25 years in this great business. It's been wonderful, and you guys are wonderful. I thank you for allowing me to help you with the financing of your customers. So that said, have a great Thanksgiving. It's the bartender, it's the waitress, the AC guy who owns his own company, the roofer. It could be different people in different lines of work that we may think, their income's going to be really difficult to quantify or qualify. And let's not bring it up that I'm in real estate or I'm in real estate finance. And to that, I say no. Bring it up, get the conversation going, because we have options for people. And those options are the following. I did want to share with you today some specifics about the different ways that we're calculating income today. You go back 3, 4, 5 years ago, we really only had one way to calculate income, and that was a standard W-2 pay stub type loan. 80% of what we do is under the conventional FHA or VA product line. Those loans do require W-2s, pay stubs, a more general type of income. We can use tax returns as well under the standard income calculation, and we actually take the tax returns today and load them up, and it generates an income calculation for us. If you are self-employed, we do attempt to start with a standard loan and then work our way down to these other forms that we're about to discuss. The standard loans are better because the down payments are, minimum down payment is 3%. On a VA loan, it's 0%. So there's a lot of advantages to being able to document or show us your income in a more conforming format. However, if you don't meet these requirements or you have a great accountant, then we can look at other ways to look at your income. The first one is a bank statement program, where all we do is take the 12 months last business bank statements, divide it by 12, throw in a little extra calculation. I think we're knocking off about 10% off of that. And that down payment on that program is 10% down. So if you've got a $400,000 home, self-employed person comes up with 40 grand, the 12-month bank statements meet the income calculation required, credit score, we're good. They can actually buy a home. A self-employed person who's been self-employed for 12 to 24 months can buy a home using their last 12 months bank statement. A lot of people that are self-employed also are getting paid using 1099s, which you in the real estate community are well aware of what that is. And for a 1099, we need 1 year of 1099. You just divide it by 12, take a little bit off of that. That loan is also 10% down. And then finally, these are all for primary purchases, but we also have the debt service coverage ratio loan, which is for our investors or people that are going to state that the property is going to be an investment property. And really that program, we're looking for 20% down. And then the appraiser goes out and appraises the home, and the appraiser will come back to us and tell us what the amount that home will rent for. And as long as that rental amount is equal to or higher than the actual payment, we have a loan. So again, income for home loans has gotten pretty flexible, and we're here to help work these and get these loans done. And primarily we get these done just about as quickly as we do our standard, which is going to be average start to finish on a purchase about 17 to 20 days. So let's get out there. Let's see if we can find a few extra buyers, because we are big believers in home ownership. We are helping people move from housing to home ownership. Take care. Have a great week.